transfer pricing does not exist in a vacuum. It sits within a broader international tax framework. Let's look at three pillars of that framework: tax treaties, the OECD and UN model conventions, and the BEPS project. Tax treaties, formerly called double taxation agreements, are bilateral agreements between two countries that determine how cross-border income is taxed and by whom. Most countries have dozens or even hundreds of such treaties. The OECD publishes a model tax convention, and the UN publishes its own. Countries base their treaties on one or both of these models. Article 9 of the OECD and UN model conventions is the cornerstone of transfer pricing in a treaty context. It says, if two associated enterprises set prices that differ from what independent enterprises would have agreed, then a country can adjust the profits accordingly to reflect the arm's length outcome. Article 9 also introduces the concept of corresponding adjustments. If country A increases the taxable profit of company X by $100 million, then country B should reduce the taxable profit of company Y by $100 million to avoid double taxation. Now let's talk about BEPS. In 2013, the OECD launched the Base Erosion and Profit Shifting Project after public controversy over aggressive tax planning by multinationals. The project produced 15 action plans. The ones most directly relevant to transfer pricing are Actions 8 to 10, which align transfer pricing outcomes with value creation, particularly for intangibles, risks, and capital, and Action 13, which overhaul transfer pricing documentation requirements. Both treaty law and domestic law must be considered in any transfer pricing dispute. A country's domestic law must authorize the tax authority to make adjustments. The treaty then governs how those adjustments interact with the other country involved.